Improving your credit score could provide you with multiple benefits, including the ability to finance a car, get a mortgage on a home, reduce your current expenses with a lower interest rate, or take advantage of some of the benefits offered by credit cards. While some people advise not to use credit at all, there are some perks associated with a high credit score and the prudent use of borrowing ability. Here are 5 things you can do that will help you boost your credit worthiness. If you enjoy these videos and would like to see more, be sure to hit the like button and subscribe to the channel. Get current. The first thing you need to do to improve your credit is to make sure all your bills have been paid and everything is current. That old department store credit card, your car loan, mortgage, and any other payments you have. Whether or not you pay your bills on time is likely the single largest factor impacting your credit score. This is because lenders take into consideration your payments when predicting future performance, and they might hold a history of missed payments against you when you apply for any type of credit. You need to pay all your bills on time, including your cell phone bill, rent, utilities, and so on. If you have trouble keeping track of all your bills and their due dates, set up reminders or automatic payments. Late or missed payments can affect your credit score for 7 years, but their impact declines over time. In other words, older payments have less effect on your credit score. Pay off debt and reduce balances. Paying down debt is a great way to increase your credit score. Credit lenders see your credit as a large pie or your total borrowing ability. The larger the piece of your available credit pie that you owe on, the less that remains for you to borrow. To a lender, you're a greater risk than someone who owes only a fraction of what they could actually borrow. Obviously, this can adversely affect your credit score. While it is beneficial to your credit score to use your borrowing ability responsibly, keeping your borrowing to a minimum by paying cash for things that you purchase will keep your credit score as high as possible. An even better strategy to use if you need to increase your score is to use the cards frequently but pay those balances off immediately to boost your credit score. It's best to have all cards paid in full every month, as this will decrease your utilization ratio or the percentage of your available credit that's being used currently. Don't apply for credit too often. Because most major purchases require a credit check of your FICO score, a prospective lender runs your credit through one of the major reporting bureaus like Experian or TransUnion. When this occurs, your credit takes a small hit. These credit checks by lenders affect your score depending on whether it is a hard or soft credit inquiry. A mortgage application, a car loan, or any large liability application will require a hard credit check, and it will impact your credit score negatively, but fortunately it only has a small temporary effect, unlike a missed or late payment. Too many hard credit checks illustrates to lenders that you're preparing to borrow money, and this, when done too often, will decrease your credit worthiness. Lenders view these inquiries as preparation for more debt, and they can reduce your borrowing, or more importantly to a lender, your repayment ability. The last thing banks want is a borrower planning on taking out multiple loans in the near future. Keep credit cards open. Some people incorrectly assume that canceling a credit card is a good idea, and that it will actually increase your score. This is usually not true. Credit cards have borrowing limits, and when you open a new account with a card, your total borrowing ability is deemed to be higher. The more cards you have open, the more debt you can handle, assuming the credit was responsibly given to you. When you close a credit card account, you lose the debt borrowing ability associated with the card, and your total debt carrying ability is reduced. This often results in a reduction in your credit score. If you have old accounts that you never plan to use again, it's best not to cancel them. Instead, use these cards for their cashback bonuses or for small purchases that you can pay in full at the end of the month. Check the accuracy of your credit report. Credit bureaus often contain erroneous credit scores. The Policy and Economic Research Council found that about 19% of credit reports had errors, with only 1% of disputes leading to a meaningful change in an individual's credit score. The FTC found out that about 20% of consumers have an error on their credit report, and 25% of those consumers have a big enough error to affect their credit score. A later FTC study suggested that even after disputing errors, almost 70% of consumers still find inaccuracies. It's worth keeping an eye on your credit score by using free educational reporting agencies like Credit Karma or Experian and correcting errors if they appear. Did you know that having good credit may mean you qualify for a car insurance discount? By following these steps, you'll be on track to improving your credit score. Even if you're not planning on borrowing money anytime soon, if the need arises, you'll be as prepared as possible. Subscribe for more videos.